Welcome to the Make It Personal podcast presented by Mutual of Omaha Advisors. Make it personal. It's your money. It's your plan. It's your future.
There are three primary assumptions that go into creating a financial plan that will ultimately have a big impact on your plan. And there's one of them that some so-called financial gurus often get wrong. Financial planning is only as good as the assumptions that are built into it. You know what they say, garbage in, garbage out. When you sit down and create a financial plan with an advisor, you create it based on a number of variables. Calculations, in fact, are generally based on two types of variables. First are facts, or things that we know that are true, at least for the moment. Facts are things like your age and income level. Second are assumptions. These are educated estimates or predictions about future events, variables, and conditions that we believe are reasonable to expect in the future. Assumptions that we must make include examples such as when do we want to retire, how much we expect our income to increase each year, and where do we believe the tax rates will be when we retire. While facts and assumptions are necessary for building a plan, the challenge is that facts will change, and at least some of our assumptions, if not all, will turn out to be wrong. While there are many facts and assumptions that we have to use or make when we're building a plan, there are three primary assumptions that hold a lot of weight. First, longevity. How long do you expect to live, or how long do you want your money to last? Second, inflation. How much do you expect, or do we expect, the cost of living to rise over time? Or how will your expenses, and therefore your income needs in the future, be impacted by rising costs? And third, rate of return. How much do we expect an investment will gain or lose over time? Or how will your money grow in the future, both during the accumulation and distribution phase? While it's impossible to know what the future holds, it's critical to ensure that these assumptions are reasonable. This is one of the many places that a trusted advisor can help. Okay, I could throw taxes out there as well as another assumption that's important in financial planning. Instead of talking about taxes today, I want to focus on rates of return assumptions. Before I get there, please let me introduce myself. My name is Mark Zagurski, and I'm the Director of Strategy and Communication for Mutual of Omaha Advisors, a division of Mutual of Omaha. We're nearly 1,000 advisors strong nationwide, and each and every day we help our customers to imagine, plan, and secure their financial futures. So what's the difference between average rate of return and actual rate of return? These are two different things, and they are not created equally. While financial gurus often tout a 10% annual growth in the stock market, which may seem impressive, the actual dollar amount generated can significantly differ when you factor in market fluctuations and real-world returns. To show you the difference between the average rate of return and actual results, let's look at a brief example of a $100 investment over 2 years. Let's assume we invest out $100. I'm using a small number such as $100 in an attempt to keep the math simple. At the end of year one, let's say that you earn 100% return, which is a number we've chosen to keep the math simple. At the end of year one, your money would double if you earned 100% return, and now you would have $200. In year two, unfortunately, you have a loss of 50%. Again, fictitious numbers for simple math. After that negative return of 50%, you're now back down to your original $100. The person selling you the investment would tell you that you have an average return of 25%. 100% minus 50% divided by 2 years equals 25%. Does it feel like you earned 25%? Average rate of return is a simple calculation. You add up all of your annual investment returns and divide by the number of years. Again, advertisement for investment products usually leverage average rate of return. Actual rate of return is a more complex calculation that adjusts for investment returns to account for both gains and losses. Let's take a look at an example with a little bit more to it. For this, we're going to consider the S&P 500 index. The Standard & Poor's 500, or more simply the S&P 500, is a stock market index tracking the performance of 500 of the largest companies listed on stock exchanges in the United States. Over the last 30 years, ending with December of 2024, the return of the S&P 500 has been 10.59%. If we invested $10,000 at the beginning of 1995 or that 30-year period, and simply compounding it by 10.59% average return over the period, we'd have nearly $205,000, more specifically $204,869. Unfortunately, that's not how the math works. While it's true that the S&P 500 earned 10.59% over that 30-year period, it did not earn 10.59% each and every year. Some years were higher, some years were lower. Some years had positive returns and others had negative returns. In fact, in 18 of the 30 years, the annual return of the S&P 500 was greater than the 30-year average of 10.59%, with the highest annual return over 34% in 1995 during that entire time frame. Over the 30 years measured, there were 23 years of positive returns and 7 years of negative returns. And it's the order or sequence of those returns that really matter. Yes, the negatives have an impact, and so does the order of the other returns. As a matter of fact, had I invested $10,000 at the beginning of 1995 and kept it there for 30 years, I'd actually have closer to $131,000, as my real return was 8.97%, not 10.59. Wait a minute. So the S&P 500 had an average annual return of 10.59% over 30 years, but the real return of having money invested in the S&P 500 over those same 30 years is 8.97? Yes, and that is the difference between average returns that you often hear quoted versus the actual or real return of having money invested. I fully accept that you cannot actually invest in the S&P 500 index. Instead, you'd have to purchase an S&P 500 index mutual fund or exchange-traded fund, more commonly known as an ETF. Investors should be interested in the actual rate of return, not an average, as investment losses can easily be hidden by using an average rate of return. How does this manifest itself as you watch videos or content from so-called financial celebrities online? They may tell you something such as the S&P 500 earned 9% over the last 20 years, and therefore you're okay to withdraw 9% from your account during your retirement. While the example is made up, the point is that many so-called financial gurus may lead you to rely on average returns instead of real or actual returns. Back to where we started talking about assumptions. Where can assumptions like this lead you astray in your planning? First is when making an assumption about how much your money may grow during the accumulation phase. We need to make sure that our growth assumptions during the accumulation phase are both realistic and aligned to our tolerance for taking risk. We run the risk of overinflating our projections if we fail to align our rate of return assumptions with reality. This may lead to us ultimately underfunding our plan. Second is when making assumptions about how much your money will grow during the distribution phase, or as importantly, the percentage of withdrawals we can make to generate an income each year in retirement. Basing our withdrawal on the 10.59% average return instead of the 8.97% real rate of return may well lead us to running out of money earlier than we expected. As we discussed before, one of the major risks that retirees face today is outliving their money. You need a plan to help ensure that your money outlives you. Making assumptions are necessary when it comes to creating a financial plan or retirement plan. All assumptions are wrong, some assumptions are useful. Let me say it this way. All assumptions are wrong, and that we know whatever we use for our rate of return assumption, for example, is not very likely to be our actual or real rate of return over time. Yes, a broken clock is right twice per day. It's one thing to create a plan, it's another thing to regularly update it, and yet another to stick to it. This is where a trusted advisor can help, and quite frankly, where they earn their keep. Reviewing your plan at a minimum of once per year and making small but regular adjustments greatly improves the chances of reaching your goals. The truth about making disciplined financial decisions, as well as attaining the financial goals you may have, is that they can be solvable with the help of a financial advisor. There are a lot of places where people seek financial advice or guidance on personal finance. The thing about personal finance is it's personal. If you want your plan to be personal, it has to be tailored to you. It's never too early to create a plan to give you the financial security and freedom you deserve. Take control of your finances and your future and schedule a no-obligation consultation with one of our advisors today. Go to www.markzagurski.com www.makeitpersonalpodcast.com to learn more, to get connected with an advisor, or download our ebook, or subscribe to our monthly newsletter. Also, please like and subscribe our podcast. Besides the assumptions that I mentioned, are there others that are part of your plan that you're concerned about? What did I miss? If you're watching or listening on a platform where you can comment, please do so, as I'm curious for your thoughts. At Mutual of Omaha Advisors, we understand that personal finance is personal, and financial well-being is essential to achieving your life's goals. Our vision is for every customer to be able to imagine, plan, and secure their financial future. Make it personal. It's your money, it's your plan, it's your future.
This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. Mutual of Omaha Investor Services, Inc. does not provide tax or legal advice. Please consult with the appropriate professional regarding your personal situation prior to making any financial decisions. Strategies discussed may not be suitable for everyone. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Mutual of Omaha Advisors is a division of Mutual of Omaha Insurance Company.